All right, guys, welcome. Wednesday live at 5, the educated home buyer. We're looking at Josh's chest there. Fantastic. The goal here is to help you buy right, borrow smart, build wealth through real estate ownership and financing. And how we're going to do that. So, we're going to answer your questions that you have about the housing market, whether it's real estate, whether it's mortgage. We're going to try to guide you through that process of home ownership. Maybe you're selling a property, give you some guidance there as well. I'm Jeb Smith, as many of you guys know. My esteemed guest, once again, Josh Lewis, our resident mortgage expert. Josh, welcome to the show.
Thanks for allowing us to ride along and co-pilot with you, keep you from running it into the side of a mountain.
Hey, bro, it's happened before, and it'll probably happen again. Before we get into what a lot of people probably want to talk about is the Fed interest rates. What's happening in the market right here today. I want to take a minute here and just say thank you to all of those of you who have supported me over the last couple of years, hit 50,000 subscribers. For many of you guys, it doesn't mean anything. For me, it was a goal, something I wanted to achieve, and I am grateful to have the opportunity to have done it, and it's thanks to you guys. And so just wanted to say thank you there. Josh, we've got the podcast going. We're doing one episode a week, The Educated Home Buyer. If you go to theeducatedhomebuyer.com, you can find, the website. You can subscribe to Apple, Spotify, whatever your platform is. It's longer form content. So if you're watching this sort of thing, it is not 2 hours like we typically do. It's 20 to 30 minutes typically, but we dive into one topic in detail versus multiple topics over the course of this show. So if you want longer form content, don't want to look at these faces because I'm really close to the camera here with this new lens, check it out. Subscribe and rate us and all that good stuff that you do on a podcast. So Josh, the Fed met today. They did essentially what we were thinking they were going to do, which is raise 0.25%. But they also had some additional language in there that I think we want to talk about. But let's start by just talking about what does the Fed raising the Fed funds rate today, 0.25%. Does that mean interest rates went up 0.25%? What does it actually mean?
No, rates were up a little bit today, but Fed Day, if you go back and if we pulled up the funny little candle chart for you guys to look at, which we won't do because we have to go back, a year. If we've looked for the last 6 or 8 Fed meetings, the Fed did nothing and the bond market sold off terribly and for multiple days afterwards before sort of correcting after absorbing the information. But the reason why it sold off and interest rates got worse after the last 6, 7, 8 Fed meetings is that markets, investors, especially investors in bonds, have been begging, screaming, hoping for the Fed to do something to put the brakes on inflation. So our Fed for the last 20, 25 years has done too much too soon and too little too late. So they came in way too heavy during the COVID crisis. And if we're all being gracious, we can probably say that was warranted. None of us knew what the hell was going on towards the beginning of COVID, and it was scary. Didn't know if a third of us were going to die, didn't know what it meant for the world, the economy. So the Fed came in
I didn't know
heavy.
if I had a job, quite frankly.
It made you a YouTube
That's why
channel.
I started YouTubing.
You didn't have a YouTube channel prior to that, and now you do. So for Jeb, it was a blessing. But for all of us, and the Fed included, it was a scary time. You had no idea what was happening and where the market was going to go from there. So they came in hot and heavy. They stayed in way too long. They didn't count on the government. Republicans, Democrats, everyone signing, we need more stimulus. Here's more stimulus. Let's give more money away. It led to high inflation. And so last year, the markets were looking for the Fed to start taking away the punch bowl, stop buying mortgage-backed securities, stop buying treasuries. And they didn't. They didn't start doing that till January. And, I look back and I'm like, I should have been harder on them because I'm thinking, well, it's a little late, but it won't be a problem. They're going to do that by late spring. We start seeing better year over year inflation numbers and things will kind of calm down. None of us could have anticipated the situation in the Ukraine. None of us at this point know what it means in the long haul, but it's not good for inflation. Those numbers should have been moderating. We should have seen some of those COVID effects working their way out this year. And we are seeing the potential for some long-term structural changes out of the Ukraine situation. Not literally a tiny little country in Eastern Europe that doesn't impact the Western world very much, but in the way we have treated Russia, the way we've retaliated against them without bombs, but with financial disincentives and incentives. It's going to be interesting to see how China reacts to that and what that does for globalization. One of the big tailwinds for inflation to go down the last 40, 50 years, which we talk about a lot, was increased globalization. You didn't have to make things in Cleveland and Detroit. You could make them in Taiwan, and then you make them in China and Vietnam, and those prices go down. And we're going to see less of that going forward due to supply chain issues during COVID. People always want to bring production closer to home. And then China is going to want to be less dependent on the US dollar and dollar denominated purchases in their economy going forward. So, long way of saying, back to the Fed today. The only thing the Fed could have done today that would have been bad for interest rates would be to do nothing. Everyone expected a quarter. Before the Ukraine situation, we were hoping for a half, expecting at least a quarter and hoping for a half. And you say, are you people crazy? Why are you talking about hoping for a bigger raise? At this point, the markets want to see something dramatic out of the Fed that, hey, we get it and we're in charge and we're going to step in and do it. Now, the downside is because of the global issues raised by the Ukraine situation, everyone realizes right now in the current market, the Fed doesn't have a lot of control. The Fed raising rates is not going to have the impact that it normally would. The big one, Jeb, that we want to be looking at right now is yield curve inversion. And what that's telling us, the Fed hiking rates really controls the short end of the curve. So 2 years and less in terms of Treasury securities. So we're seeing those go up. And yet we've seen, for the most part, after the first 4, 5, 6 weeks of the year, 10-year treasuries remained relatively flat. It's gone up, but not nearly at the pace the short-term treasuries have. So I didn't look at it at the close of the market, at the open of the market today. The 2-year, 10-year spread was about 0.27%. When that goes negative, when 2-year securities are higher yield, a higher interest rate than 10 years, that has predicted the last 5 or 6 recessions. And more importantly, what it tells us, you see and read and hear in the news, and you go to the gas pump, you go to the grocery store. I ate at the Habit yesterday and ordered something I ordered many times, and I looked down, it was like $3 more. Like that's a lot when you're just at a burger place and you're paying $3 more on a meal than what you paid 6 or 8 months ago. We're
I
all
thought you were on
keenly
a diet.
the Habit. I did have a diet. It was a nice salad. Listen, bro, don't challenge me. We so in looking at that, we're all keenly aware of inflation, whether it's the media just railing on it every day or seeing it every day in your life. So it's a real thing, and we need to be aware of it. The bond market is looking out and saying, hey, over 10 years, we're not worried about it. A 2% yield on the 10-year, or 2.17, wherever we ended today, relative to the last read on inflation being 7.5%, that's a negative 5.5% return. Investors may be irrational, but they're not that irrational. What they're saying is, we don't believe inflation is going to be that high over the next 10 years. So, long way of saying, the Fed's action today, the Fed meeting, everything they said was to be expected. There's not a lot they can do to control things or improve things in the short term. They did telegraph to us, Jeb, what, 4 or 5 more increases coming the rest of the year unless
Yeah,
something
yeah, and I
dramatically
think
changes?
what I was watching is that I think 7 is like a 60 something percent baked in, right? So there's 67% that they'll do 7 hikes this year, and there's even an 8th, which will take you into what, February of next year, I believe, and that's that's over 50% at the moment. So it'll be interesting to see how that plays out. But let's instead of predicting how many times you're going to raise it, let's talk about something important here, and that's the balance sheet runoff, right? So if the Fed allows treasuries to run off the balance sheet, what does that do to rates? Or what are your thoughts?
Way less concerned about them running off their balance sheet of treasuries than mortgage-backed securities.
Right.
So they accumulated a ton of mortgage-backed securities. They bought less of them than treasuries, but they bought a lot. They bought a lot. And I don't have the exact number. I'm sure one of you guys can Google it while we're here, but it's multiple trillions of mortgage bonds that they own. So if that supply comes to market, it could have a really negative impact on mortgage-backed security. So we've talked about if something can't be true, it won't be true. And when I say that, I mean the federal government cannot afford to have a 4 or 5% 10-year treasury. They literally can't afford it. The national debt has increased 4x in the last 15 years. So if you have a 4x increase or a 3x increase from down at 0.87% or where we were for most of COVID, to 4%, it's a 5x return on 4x debt. That's a 20 times increase in your debt service. That cannot be. But what the government could do, they could say, we don't care about mortgage rates. We care about our debt service. Hold on to their treasuries, start buying treasuries again, and sell all of their mortgage-backed securities. Now, they will never do that. The same reason why they were buying mortgage-backed securities in addition to treasuries is that housing is a large component of household wealth, the biggest component of household wealth, and it also largely contributes to the wealth effect. When your 401k is up and your home equity is up, you feel better about your finances, you're comfortable spending more money. If they said, screw it, we're going to take the next 12 months, we're going to sell our trillions of mortgage bonds, and we're going to run interest rates to 6.5%, it would have a huge negative impact on home values, which would have a huge negative impact on the wealth effect and consumer sentiment and the economy as a whole. So all this stuff, it's like butterfly effect. It's all interrelated, and it's almost impossible to separate it where we can say, this is going to happen, this will be the impact. But we know that they have a large incentive to keep treasuries down, to keep their debt service down, keep interest rates in check so that home values don't decrease based off of where they're at today.
Got it. So before I get into the next question, I want to ask a question of those that are listening. Do you like the format in watching this of what this looks like? So we'll call this 1, or do you like it like it normally is, like 2? So this would be 2. This would be 1. Which one do you like more? Because we'll throw it back and forth, and whichever one you like, and that's how we'll shoot it. So let me know. But the question I'm going to ask right now, I think, is an important one. So rates today sitting just over 4%, give or take, an 8 there. Logical thinker. He mentioned this on a video that I posted Monday, I believe. And it's a great comment, and it's something I want to throw out there. So in July of last year, rates were around 2.875 at the time. You thought that if mortgage rates went back to 4.5%, it would be problematic for the housing market and for able demand. And he actually referenced that part in the live where he asked the question and you gave the answer. So
I'm worried that he's either recording or taking notes or has an awesome memory. So going forward, we're going to be real careful about the things we say.
Well, no, I mean, listen, this is why, the internet's a funny thing, right? If you say something awesome, it's going to be there forever. And if you say something that sucks, people are going to let you know. And trust me, I get it all the time. So let's talk about that. 4.5. So let's rewind for a moment. So at the moment, rates sitting at 4%, demand is still incredibly high. Now, is it incredibly high relative to, other times in the market, or is it just relatively high because there's just absolutely no supply out there and buyer demand just appears way higher than it would otherwise? But regardless of the fact, rates have came to 4%, reached 4%, and the market hasn't necessarily slowed down from a buyer demand standpoint at the moment. So rates move up another 0.3%, 0.5%, 4.5%. Josh, is that a problem at the moment for the housing market?
I think you and I have both been sort of shocked at the resilience of the market, because I would go so far as to say it's the only impact it has had is to just knock some people out of the market. If you qualified for a max of $500,000 and you look around and now homes in your neighborhood are $580,000, it's hard to substitute. You're then looking further out, or you're going to continue renting, or you buy a smaller property. And I'm seeing a lot of people that when we get them their max numbers, they just, hey, we just have to hold on. A lot of it is just sort of, deer in the headlights and just paralyzed. And there's not a lot of good options in that situation, but we're seeing a lot of inaction from the people who are not very well qualified with the ability to absorb that increase in rates. But with all that said, all of our buyers that are qualified and are out there, it's not like that losing out some of that able demand has brought a supply demand balance. still, I mean, you've gone through the numbers repeatedly here, Jeb. Any property that's remotely desirable in terms of location or upgrades or school district, they're getting huge numbers of offers. I couldn't tell you when the last time I had a client not be in a competitive bidding situation. Like literally, I couldn't tell you. It's been 2+ years since I've had a client go, "Hey, we found this house. It's been on the market for 6 weeks, and we were the only offer, and they accepted it." It just doesn't happen.
No, and again, something we'll point out, real estate's local, right? So depending on where you are, it might be a little bit different. But yeah, I mean, I'm giving you examples in the videos that I shoot about recent properties that I've listed and the activity. And it's crazy. I mean, the one that just went into escrow this past weekend, $250,000 above the asking price at $1,050,000 list price. So nearly 25% on that property. There were 21 offers. 3 of them, I believe, were cash. 18 of them waived the appraisal contingency. Only one was under the asking price. I mean, and it was ridiculous at that. It was like an investor trying to buy a property that, they have these people just out there making offers on properties, hoping somebody will bite at something. And I'm, essentially wasting their time. But nevertheless, it's a strong market. I mean, even when I was back home, rural Eastern North Carolina, Don Trans Chapman is watching right now.
I was going to ask. He said Matthew and not Jeb. I'm like, that's got to be someone from Kinston.
That's someone I went to school with for my entire school career outside of college. So Don Trez is saying, I was back in that market, and dude, the market there is selling at or above the asking price. And this is, again, I've mentioned this many times. This is a place where there's a lot of land, a lot of opportunities to build property, and demand is still high. Things are moving relatively quickly. So just, again, real estate's local. And I always update you guys on Orange County, California, where I'm located, just to keep you in the loop of inventory here. Today, coming on the show, we had 1,424 active listings in all of Orange County. So that's, again, 3.3 million people. We had 1,424 listings. Huntington Beach had 95. Now, at the lows of this show, right at the beginning of the year, we were at like 960 listings. So listings have gone up, what, 500% or 50%, however you want to look at it. No, 50% since then. It wouldn't be 500%.
500%. We'd have a nice supply demand.
Yeah, there would be a nice supply of homes. So 50%, 500 listings is what I meant to say. And then in Huntington, we got as low as 60 something, as high as I've seen 120, and we're down to like 90 something. So there are properties coming on the market. They're just going into escrow relatively quickly. So just keep that in mind when you're out there looking, and things are still moving. I personally believe, I mentioned this in a video, as rates stay high, we get through the spring, I think you're going to see a slowdown in the market. Now, does that mean, home prices dip? Not necessarily. I just think, the 20 plus offers on a property is going to slow down at some point if rates continue to go up. Now, for whatever reason, Ukraine, Russia situation, I'm not going to say use the word resolve, because it's not going to resolve itself in any form or fashion. But if it slows, they're able to come to some sort of agreement, and some trade starts to happen back and forth between commodities and Russia and different parts of the world, you might see prices on oil and some of these other things come down, but still food costs are going to remain high. There's going to be some other factors out there that just aren't going to solve themselves immediately. So costs are going to be high. If interest rates stay up, it's going to put pressure on people. Maybe not necessarily in the market that we're in here in Orange County, just because there's a lot of money running around here, but small towns, where I grew up, 20,000 or so people, when food costs goes up, exponentially, they can't pass 100% of that along to the consumer, to the buyer. But what they do pass along affects those people a lot more than, say, where we're located here in Orange County. And that trickle effect starts, it takes time, but it will eventually slow things down. So, but nothing happens until supply starts to increase. You got to have more supply than you have demand to give some sort of balance in the market. Josh, anything you want to add to that before we start diving into questions here?
No, the bigger thing is we have issues that we're dealing with, and Ukraine again doesn't matter to the U.S. economy in the sense that they contribute anything directly to us. They contribute to a large portion of Europe and even African supplies in terms of food and energy. And the most important impact that's coming out of this, let's say that the situation is resolved, that they come to some sort of peace treaty tomorrow, whatever that may be, and they stop fighting. That would be awesome. The What Russia has done and the way they've isolated themselves from the rest of the world is going to have repercussions for years. Europe has a plan to be independent of Russian energy by 2027. That's not going to change. I can't foresee in the next 5 years them waking up and going, hey, you know what? We totally forgot about them invading a peaceful country who was no threat to them directly. So let's go and buy our energy from them again. So those things are not going to change. What you're going to largely see is Russia be somewhat like North Korea in terms of being cut off from the rest of the world economy. The difference is North Korea doesn't have a lot to offer to the world economy. Russia did in terms of energy and grains and some gold and diamonds and a few other things. So it's going to have long-term impacts, and we're just going to have to see what that looks like and what that means for interest rates. You know, we've talked since Jeb has had this show, and we've been on here every week. We talk about the long-term structural implications of government over-indebtedness and that being deflationary, leading to lower interest rates moving forward. And that meaning higher hard asset prices as well, including houses. Well, those structural details are still in place. Nothing has changed, but we have some new ones in terms of the decrease in globalization and bringing supply chains closer to home. And we're not going to know how that plays out and how it impacts interest rates for another 2, 3 years.
No, for sure. And getting back up, there were a couple comments at the beginning of the show. So the title of the video is "Are Cash Buyers Ruining the Housing Market?" And Antonio put a question in here at the beginning of the show. Just said, just lost out on a second house because of the appraisal gap. But one of the comments that was on the show, I'm gonna comment on that in a minute. But M put this comment on here before the show actually was even live and just said it's not the cash buyers, it's the buyers that are willing to pay above market value that are the problem. So in a sense, all of this is kind of correlated in a way that, you know, there are properties that aren't appraising, right? I didn't have that issue 6 months ago, 8 months ago. Most of my properties were appraising. In fact, I didn't personally have an appraisal issue for, you know, this entire duration that home prices have been going up. But recently I have had, and you know, cash makes up that difference, right? The last one was $100,000 gap difference in what the property sold for and what it appraised for. And the buyer came in and paid the difference. Whether they came in with cash or they restructured the loan, whatever they did, there was a difference that they came up with that wasn't negotiated to lower the price. And so that, if you're looking from a buyer standpoint, is the problem, because now that sets a precedent with regards to what values are in certain neighborhoods when those appraisal gaps are met, right? Because now that is a comp. Now, one property doesn't necessarily change the comps for the entire neighborhood, but it starts a trend that could start to set a precedent that could change the values in a neighborhood. So whether it's cash buyers, cash on hand, big down payments, whatever, that cash gives people the ability to make decisions that you wouldn't otherwise be able to make. And in an environment right now where things, you know, are very much in favor of sellers aren't willing to negotiate. And therefore you do need the cash to be able to make up some of these differences in most markets. So just, you know, every property is not appraising. Just understand that, right? It's not like, hey, you know, the appraisers are out there, you know, falsely reporting values to make it come in. No, it's not the case. The appraisers are doing their job, and properties aren't coming in some cases, but the buyers are still stepping up. So just know what you're up against if you're out there competing.
Let's, Jeb, I
Yep.
just want to focus here. So let's look at the question. It's the buyers that are paying above market value that are the problem. It is impossible to pay above market value. In the open market, the market sets the price of anything. So it is today's market value. we may be of the opinion that tomorrow's or next month's or next year's market value may be different or lower, but we get this a lot. The people saying, well, they're paying above the value of the property. The value is in an open market with no duress what a buyer and a seller agree to the price to being. So we don't like that the sellers have all the power and that there's 12 buyers that are bidding to be the one that gets selected by the seller. It's not fun for anyone other than the seller, including their agent. Makes it difficult on them, makes everything harder, but it's the reality of the market. So stop thinking in terms of people are paying above market value. The market is dictating what the value is. And it's not an appraisal. It's not what it was yesterday. It's not what you qualify for or what you hope to pay for the home. It's what a willing and able buyer agrees in an open market to pay for the property. It sucks and it's not fun, but those are the market values today.
No, good point. So, way to point that out. So let's get into some questions here. We've got a couple. Simple name is Weeding, and yeah, I'm not sure what that means, but he's listening to the show, or she is,
In
and we
Colorado, it
appreciate
means
that.
something different.
Yeah, so we appreciate you Weeding and listening to us. And then Simple Name goes on to use their name in the third person. It says, is going through a divorce, is a FHA loan best, or is a cash out refinance for interest rates looking out for my kids? So I feel like there's a piece of that question missing. Josh, are you understanding the question?
Yeah, they're just
Okay.
asking in a divorce, is the FHA loan the best or going for a conventional cash out? And what I will say is the scenario never dictates which loan tool is the best option. One of our friends, Kyle, over at Win the House You Love, has a video out right now saying that he doesn't think FHA loans are good options. And I look at this entirely differently. If you guys have been here week after week, you've heard me say 1,000 times, probably tired of it. Numbers never lie. Loan officers lie, salespeople lie, people with an agenda lie. They don't necessarily all do, but they can. The most important thing you can do is have someone present you the options with a tool. So we have to look side by side. If the borrower qualifies for both FHA and conventional, what is the difference? So just without knowing anything in this situation, FHA is going to have a lower interest rate, but it's going to have mortgage insurance, even if you have 20% equity in the property. So going through a divorce, there could be more than 20% left. There could be less than 20% left. In addition to that, we have an upfront mortgage insurance premium of 1.75%. It's the equivalent to paying 1.75 points. So you have to look at base rate plus mortgage insurance plus that upfront mortgage insurance premium, compare those all out and see which option is better for you. A lot of times the FHA is far and away the best option, and it's at a much higher credit score than most people think. We just have to pencil it out for the borrower so they can know the pros and cons of each option and make an educated decision of which is best for them. It's part of the trouble of a medium like YouTube. Everyone wants to get views, so you have to have a sensational headline or get at least an attention grabbing headline, and saying things like, hey, FHA is not the best option is one way to do it. But in reality, it's nuanced. Sometimes it's the only option. Literally, like you can't qualify for any other loan. Sometimes you have both options, and going conventional could be better in the long run, but have a higher monthly payment or more cash due at closing. You have to work with an expert who can actually determine all of your options, determine what you qualify for, and present them to you in a way that you can see the cost today and over time and accurately analyze them.
Good stuff. Apollo Supernova, not a question, but a comment that I like. It says, love the educated home buyer. So that's our podcast. Listen to it during workouts instead of music. We are inspiring people to work out. I think that's what I read there. They didn't work out prior to listening to the podcast, and that made them start working out, Josh. So we're making people healthy. That's what I get from reading that. All right. So let's see here. So a lot of people like 1, a lot of people like 2 on the format. So we're just going to go 1 tonight to change it up, because we always do the other way. And this mustache thing on my face is actually, yeah, it's taking up a lot of the angle of the camera here. So backing it off just allows people not to stare right into it, which is probably a good thing. Let's see.
So Jeb, the problem was I was reading through everyone's votes, but I couldn't remember which one was 1 and which one was 2.
This was 1. The other was 2, just because we
Okay,
started on this one. So,
gotcha.
all right. Um, let's go. I'm not able to read some of these questions before I put them up there. So I'm just going to just throw some questions up here. What's going on with the spring market? I've been watching my local market in Chicagoland, and I'm not seeing a lot more properties. Is it supposed to start later than March? No, typically this is the time of year that you start to see properties come on the market. In fact, it starts about a month ago. We would normally see more active listings on the market. This could be a number of things, right? If you're in an area that still has snow, it's cold, that might delay some things. But honestly, what I personally believe is that there are a lot of willing sellers out there, people that want to sell, people that want to move for whatever reason, but they don't see the inventory that they want to purchase in whatever market it is. Maybe it's the market that they live in, maybe it's they're moving out of state and they're looking at inventory there and they're not seeing a property, therefore they're not willing to sell. That's one. Two, rates have gone up considerably. I mean, my personal residence, I have a 2.99% interest rate, right? So I'm just under 3%. Looking at today where I would be, I'd be at 4% or so, depending on, the scenario. So, I'm jumping a full percent. Here in California, my property taxes would also go up, incredibly because of where I purchased my current residence. So there's a lot of factors playing into people staying put. That is a problem at the moment because it keeps inventory off the market. So the fact that you're not seeing a lot of inventory, one, it's getting purchased. There's a lot of buyer demand. So as soon as things come on, it gets gobbled up. Secondly, people aren't listing their homes for the 2 reasons I mentioned. So yeah, it's a little bit slower out there than we would like to see as real estate agents. My local market here this time last year had about 2,500 active listings on the market. Today, we have 1,400. So we're 1,000 or so less than we were last year. And our peak market last year was in May. So in May, I think we had 2,700 active listings. So we'll see what this year holds. But you're not seeing things, or you not seeing things is what a lot of markets are experiencing, if you will.
Jeb, from a numbers
Yep.
perspective, I like to look at it this way. You're a seller. Last spring, you're considering selling, and for whatever reason, you can't quite get yourself over the hump, and you decide, now we're going to stay put. Maybe we'll look at it next year. Home prices up 18%, 17%, 16, pick your number, somewhere between 15 and 20%. So if you're looking at a $675,000 house last year that you were going to move up into, it's now $800,000. So we got a $120,000 gap to cross there, which some of it has been covered by the appreciation in your home that you're going to sell over the last year. But then interest rates, like you said, that we've gone from basically plus or minus 3% last year to plus or minus 4% this year. So your interest costs are, 20, 25% higher, and your home price is 20, 25% higher than it was last year. If you couldn't get yourself to list and put your house on the market last year, how motivated, there must be some sort of life event that is triggering the move this year if you didn't do it last year.
No, that's the thing is it, there's not a lot of incentive at the moment to want to move unless you absolutely have to for life, because of all the factors that I mentioned a moment ago, interest rate, prices, all of that, how crazy it is out there to have to deal with that, emotional process of buying a house. You have to absolutely need to move, whether it's a relocation, a family situation, divorce, those things that do pop up. Otherwise, like, sit back and just watch the frenzy. Watch YouTube. Watch my channel on YouTube. No, seriously, you have to have a reason to be out there in the market at the moment or wanting to sell your house in order to deal with this craziness. All right. Let's go, Gabby. Gabby D. If you had to choose between withdrawing, would you hear the South come out in me there? Withdrawing from 401k or financing closing costs into the loan, what would you do? It's a USDA loan appraised over value enough to cover cost. What makes more sense? I definitely think personally speaking, I'll let you, Josh, from the loan side, give your opinion here in a minute. But if you can finance the cost into the loan because USDA allows it, if it praises for more to finance that cost in there, to me, that would be the way I would do it. Keep my 401k completely separate, not touch it. But what are your thoughts on that?
Jeb, I'm going to go straight to the elephant in the room here.
And say the numbers never lie.
If the people in the comments over here could throw stuff at Gabby right now, the people who are dealing with appraisal shortages and having to waive appraisal contingencies, if they could throw things at Gabby right now, it would not be a good scene. So you're very fortunate to be in a situation where you have a home under contract that appraised for more than what you've paid. Neither of these are terrible options. The biggest issue with the 401k loan is that you're likely going to pay it back over a short period of time. They like to tell you, hey, here's the 5-year repayment terms. A lot of people choose to stretch it out to 10 or 15 years on that repayment. With rolling it into the loan, you're going to have it stretched out over 30 years, and you're probably going to pay yourself back at a slightly lower interest rate. So run the numbers, find out what the payment options are back to the 401k. For me personally, I would rather have it tied to the property. It's tax deductible there. The interest that you're paying back to yourself in your 401k, you're not paying taxes on it, but you're not getting it deducted, and you're not paying back that loan with pre-tax dollars. So from that perspective, I would lean towards putting it into the mortgage, but neither of them are a bad option. Just run the numbers. Find out from your plan administrator on the 401k what your repayment options are. Look at the interest rate on both of them. Paying a higher rate on the 401k loan is not a big deal because you're paying it to yourself. But just look at it. They're both really good options.
Good stuff. A blast from the past. Thanks for referring me to Adrian Riesling. He's a real pro. So is this Will?
I believe it is
now
Will.
know who people are by reaching out to us? So
tie them back to their name.
Yeah, we now know your identity. No, so I like these comments because they're good to let people know. I'm often telling you as a home buyer, if you need to get connected with a professional, whether it's a mortgage expert or a real estate expert, there's a link that I'll post here on the screen in a minute that will get you connected to somebody that knows what they're doing, will guide you in the right direction. This guy, I've referred to 3 different clients. We both get coached by the same company. We have relationships in that form. I think this is the 3rd or 4th person he's put under contract. So Adrian is awesome. Great referral. I'm glad that you got connected and were able to go under contract. So that's good stuff. So
we're going to start calling him the Antelope Valley Jeb because
there you go.
They're very similar.
But he's a good dude.
Really
Happy
good
to make that referral anytime. I did put that up there. I don't know what happened to it. Let's see. There we go. All right. So let's go back here and get some more comments. Kamal says, do you think it's good to invest in Victorville, California or Hesperia? It's more affordable. So here's the thing about investing in any place, regardless of where you go. You got to look at the numbers, right? Josh always says the numbers never lie. So to invest in something in Hesperia or Victorville at the moment, prices have gone up quite a bit, right? So you're looking at these 2 markets and you're going, okay, the cost of a home in these markets now is probably what, 400,000, Josh, give or take, maybe 450. I don't even know what houses are in Hesperia and Victorville. I would say 400. Let's go 400.
It's similar to Antelope Valley. You can still, your entry level stuff, you can find things in the 4 to 450 range.
Got you. So if we say a $400,000 house, in order to do an investment property there, to get the better of the rates, you need to put 25% down. So that's $100,000 that you've got to put down on that property in order for it to make sense. How much is that property going to rent out for? I mean, what's it going to rent for every single month? What's your number? Are you positive cash flow or negative? My guess is you're probably close to break even at best in that scenario. Now, the thing about investing in California real estate is you do typically get that appreciation over the period of time. Now, my question to you is if you took that $100,000 and you went out to another market in the United States, you might be able to buy 2 houses for that same amount of money and get more cash flow than you would be here in California. Now, the caveat to that is that you're likely not going to get the appreciation that you get in California, but you're going to get cash flow. And if you take that cash flow and put it right back down into that property every single month and pay down the principal, you're going to own that property free and clear a hell of a lot sooner than you are here in California. Now, granted, you don't get the appreciation. So you've got to figure out from an investment versus cash flow. I mean, an appreciation versus cash flow standpoint, which side are you on? Everybody wants both. I mean, that's the ideal situation is you get both. And in those situations, you can get them here in California, but many of them are short-term rentals. and those have their issues in and of itself, which we're not going to dive into at the moment, but just know what you're up against. And I don't think Victorville or Hesperia are bad areas to invest in, but understand if the market does correct, those areas are going to get hit first versus coastal California real estate. Whereas investing out of state, those markets get hit, it's less of an impact. It's because those properties didn't go up considerably like California real estate did. So a lot of things to consider there, but to each his own. You got to do what's right for you. Josh, what do you want to add to that?
I'll just follow up with a story. We have a viewer to the show here that Jeb got connected with me. We closed a refinance for her on one of her rental properties, pulling some money out. She wanted to buy another one. And in looking at it, in California, we cannot make any of these deals make sense for her. Now, part of that is just we can't go to a high enough price point where you can look at units and different stuff. But we were running through the numbers in some of the markets that Jeb, you and I have been talking about with much lower price points, yet still not similar, but much higher rents to price point than what we have here in California. And the big thing that she and I were talking about is that you can't expect the appreciation in other markets that we have gotten historically here in California. The last couple of years are a little bit of an aberration. Like everywhere in the United States has gone up similar amounts, despite the fact that supply and demand issues are not the same throughout the country. So I just wouldn't expect the appreciation. But if we're looking at cash flow, Jeb and I talk about this a lot. I've got to a point where I own rental properties here in Southern California, and other than buying a distressed property at a massive discount, which is very difficult for any of you who've tried it in the current market, other than doing that, there's not a way to make these numbers make sense. And I have, a buddy of mine who actually does some of our marketing. He helps realtors around the country and mortgage people with their video marketing. But he's from Omaha, Nebraska. He's buying in Omaha $200,000 properties, and they're doing mass marketing and buying at a discount, distressed properties, but then rehabbing them. Long way of saying, at $200,000 with 25% equity in them, these all cash flow, like $200, $300, $400 a month positive. In California, $400,000 and $500,000 properties with 25% down. So double the amount of money in them don't bring you any money. You're a little bit upside down for the most part on them. So you have to look at it differently. If you don't have the ability to put 35, 40, 45% down to make them cash flow, I would look to other markets and just make things make sense. For me, I would love, Frank's plan is to have 100 doors, single family residences in Omaha, Nebraska, and get them paid off. He's a little younger than I am. I'm 48. I think he's 41, 42. His plan is to get them paid off in the next 15 years. He's 55 with 100 homes free and clear. Now, you don't have to go that big, but most people making a good income who own their home and have fixed their housing costs could realistically look at adding 2 or 3 $200,000 homes in other markets. Now, we say that we had someone in here saying, hey, I don't think people should be able to buy more than one home. It's causing homelessness and making prices go up. And to a degree, that's true. But if you're in a position where you can acquire homes, it's a good strategy when they cash flow, and the cash flow is much better outside of California. Just don't expect California appreciation over the long run.
There you go. Jay Homeboy, let's say you want to work with an awesome realtor and an amazing mortgage guy, but the two have issues working with each other. How do you choose? I say you don't have to choose. They need to figure it out. It's not your problem. I've come across many people in my career. In fact, there's agents. One thing I tell people about in this business is don't do things that you're going to later regret. And it's easier said, because what happens is you have a bad situation with an agent or a mortgage person, that it's almost guaranteed that you guys are going to have another deal together within a very short period of time. It always works out. So instead of burning bridges, keep your mouth shut, just do your job, right? And that's the job of the real estate agent and the mortgage professional. Now, earlier in my career, I would have burned a bridge down in no time. I've learned as I've gotten older, it's not the right move to do for many reasons, but being the pro, right? And so you're the client, they should be doing their job. And in fact, the two don't necessarily have to interact that often, especially if you have assistants and transaction coordinators and all of that. A lot of the communication can be done in other ways, and rarely, if ever, are you all on the same call at the same time and what have you. So the two just need to get you in escrow by being professionals and do their jobs, and then there shouldn't be an issue. And if there is an issue, then I mean, you need to go to both of them and say, you either figure it out, or I'm going to keep the other one and find someone
Or
new
I'm going to
on
fire
this side.
both of you.
Yeah, exactly. So you guys figure it out.
Like,
Um,
Jeb, this happens to us more often than it does to you, because we deal with so many different realtors and you deal with them in a close basis. And a lot of our stuff does come from online, either your YouTube channel, another YouTube channel, our Find My Way Home website. So a lot of times it's not someone that a realtor referred to us, it's they found us and then they found a realtor. And it's funny, like, it is very rare that we have an issue with an awesome realtor. Like, Jeb, you've heard me say before, like, I know this realtor's good. She's driving me out of my mind and I want to scream, but she's a good realtor. And from my perspective, I would rather have an awesome realtor working for you that I don't get along well with versus someone who's green and new and not good and wonderful to talk to and deal with. Like, at the end of the day, what's important for me, people always feel like, well, why are you concerned with who I'm working with as a realtor? Well, because I want you to get to the finish line without losing your mind. And I can't overstate how important a quality realtor is in that transaction. And some of them are a little temperamental. And I'm sure they'll say the same thing about quality mortgage people. At the end of the day, I want a happy client with a transaction that closes more than I want to be best friends with the realtor in the transaction.
There you go. On says, is it true that you can put in a cash offer, show available funds to close, then turn around and get a loan after the offer is accepted? Talking full doc loan, not hard money or private lender. So what On is asking is, can you put in an offer for a cash, for a cash, as a cash buyer, show that you have the funds to close, and then once you get your offer accepted, say, you know what, I'm going to get a loan instead. Here's the thing. Per the contract that you've signed and both parties have executed, that would be a violation of the contract. So that would mean that the seller could say, you know what, we're not allowing this to take place because you're violating the contract, and in theory, cancel the escrow. Now, what I'm seeing is a lot of cash offers with very short closes. So it would be hard to get a loan in 7 days in many cases, right? So a lot of times cash offers have very short escrow periods to entice the seller to choose their offer, amongst doing other things. And so in those situations, it would be very difficult to make it a loan. To answer the question directly, can you do it? Yeah, you can do it, but parties need to agree to it. And timelines still need to be met in order for it to happen. But if if the seller says, no, you said cash, we're not doing anything other than cash, in theory, you would have to stick to that and or back out of the contract. I haven't seen it happen. Does it happen? I'm sure it does. But more often than not, when somebody says they're coming in with cash, it typically ends up closing with cash. And then that buyer can go refinance after the fact and pull cash out and do things that, if they want to do them. But I don't see it happen, but I'm sure it does.
I would lean more towards, if we wanted to do that, write it as a 14 or 17-day escrow and ask permission on the way in. Here's my proof of funds. I am willing and able to close with cash. We believe we can get financing done in 14 days. If the docs show up and we're on schedule to close, would you be okay with that? If it's a super competitive bidding situation, you don't want to cloud the waters. Exactly what Jeb said. Just suck it up, close it, and then do the cash out refi after the fact. But if it's a semi-normal situation and you're the strongest with a cash offer, Jeb, what do you think? I think a seller would appreciate someone saying, "Hey, I will not ask for an extension to close. I need 17 days. We're going to try to close with financing. If not, I'm writing a check."
Yeah, I think that's fair. I mean, here's the thing: is like rarely, being in the business, do I look at a cash offer and say, tell a seller, hey, the cash offer is the best offer. Unless, for example, we have a multiple offer situation, appraisal comes into play, nobody's waiving the appraisal contingency, then the cash looks attractive. But in the case this last weekend, we had 21 offers. The highest offer was at 1.3, but we had offers right behind it, that were cash too. But we chose the other offer for many reasons, just in how it was structured and what have you. So it wasn't just the fact that it was, the highest offer. There were other things they did in the offer to help it stand out, but the cash offer was a close second, but there were other offers right there with it. And so in talking to my client, it was a question of, do you care how fast it closes? Because one of the cash offers was 7 days. Do you care? Do you need the money in 7 days? And the answer was no. And it's like, okay, well, then in that case, just wait another 8 days 10 days, because it was a 17-day close. Just wait another 10 days and you're going to get, this much more money in this scenario. So, the cash offer doesn't always win. The cash offer not only has to be cash, but it also has to have the highest price and the best terms, and amongst other things. That's typically how cash offers win, at least in my eyes. Now, some people will just say, hey, I'm taking the cash offer because it's cash and, whatever. Okay. But, if you've got somebody able to walk you through that process and say, okay, cash is good for these reasons, but this offers better for these reasons. That's the conversation you need to have if you're considering selling.
Hey, Jeb, along those lines, I got a question for you. The property in Westminster, you had multiple offers. I don't remember if it was 12 or 312. 21. Yep. You had 21 offers. How do you present those to your seller and make them understand the relative differences between a financed offer, a cash offer, a 50% down offer?
Yeah. So as offers come in, I forward them over to the seller, and each one I label with offer 1, offer 2, offer 3, whatever, because I let, each offer needs to be in front of the seller. And because everything these days is electronic, I'm not going to print out 21 offers with all the financing and the buyer letters and all that stuff. It's just forwarded over to them. The seller can look at it if they want. If they don't, that's fine too. But I'm also creating a spreadsheet on my side that has a list of questions, or a list of items that to me are important in the contract. And I have offer 1, but you say the numbers never lie, right? So I'm laying out a spreadsheet that goes offer 1 through offer 21. I have the, offer 1, I have who the agent is, and each one of those, I have a list of things that we're going to talk about. We're going to talk about price. We're going to talk about down payment. We're going to talk about escrow terms. We're going to talk about, are they waiving the appraisal contingency? Yes or no? Are they waiving the loan contingency? Yes or no? Are they waiving the inspection contingency? Yes or no? Are they waiving all contingencies? Yes or no? And then from there, we go into talk. Are they asking for termite? Are they asking for home warranty? Because these are fees that are typically not, it's not that they're not traditional. It's just that fees sometimes buyers don't pay. Escrow is always typically split between buyer and seller. So that's not something I really even care about. Title is usually paid by seller, just the way the contract's written. So I'm looking at the things that can be negotiated and laying them out, and then we're going across the board. Ultimately, we're looking at price, right? I mean, price is usually first, and then from price, we go down payment. Then we look at appraisal contingency and all of these other things. And so in this case, not one of the 21 offers had less than 20% down. So all really strong offers across the board. So it really came down to price and who was willing to, waive contingencies and do things very quickly with regards to their contingency timeframes, right? Who can get us through the inspection quickly as a buyer and release contingencies with the strongest offer. And so those are all things that we're talking about. And, I'm laying it out in a spreadsheet. I'm highlighting the ones that look the best to me on paper as a real estate agent, but I'm not making that decision. I'm asking the client, okay, out of those offers that you saw across, which ones look attractive to you? What questions do you have about them? And then we're kind of narrowing it down based on that. And sometimes they don't choose the highest offer for one reason or another. Maybe there's something else that was important to them that they chose that offer for that reason. So there's a lot of things that go into it, and it's not easy, right? I mean, you've heard me tell the story a couple of weeks ago, 67 offers on a property. Looking at even it's a spreadsheet that has all the nice information in there, 67 growing across a Google Sheets or an Excel document is going to be hard for that to take in. So you've got to figure out a way that works well with you being able to understand it for one, but also being able to, more importantly, letting the seller understand it and figuring out, which one they want to go with for whatever reason. So
I can't even imagine what a spreadsheet with 67 would look like. Back in the days when we were flipping, we often had the best house in the neighborhood, quite possibly the most expensive house in the neighborhood, but the best because a lot of distressed properties, and we were a fully renovated before flipping really got big, and we would have 10, 12 offers. And for me, I had to do the same thing, create that spreadsheet for me to be able to understand all the things that you just said. And it would get confusing at 10 or 12. But I just kind of wanted to give you guys some perspective of what is the listing agent doing and how are they presenting that to their sellers. And a good agent knows that it doesn't matter, cash, loan, whatever, it's net in pocket with the least stress and headaches in the shortest period of time.
no, and I've made the mistake of waiting until the day that we're going to review all the offers to put them all into a spreadsheet. I no longer do that. As they come in, I make the time to put that offer in a spreadsheet when I send it over to the seller so that I'm not on day one putting 22 offers in, or my assistant putting 22 offers into a spreadsheet. It's time consuming. It's way easier to do it on a case by case basis. So just and it's an organization thing, right? I mean, I'm sure that there are some people that overlook things or do certain things, and because they're busy and what have you. I try to be really organized and detailed in that manner because there's a lot on the line there. And then another thing I do as an agent is I send everybody an email that they put an offer in on the property, and I tell them exactly the scenario, how many offers we had, what it sold for, and how many offers we had above a certain price, how many were cash. The reason I do that is because that's what I would love to see as a buyer's agent. I'm okay if my offer didn't get accepted. My buyers probably not as much, but I mean, I get it in the market that we're in, but it would be really nice to know right then what things sold for so that you can help your buyer understand and not have to wait 30 days or 20, whatever the days is for the property to close, because then it loses perspective as to what's happening at the moment. So you just lost out on a property. Why did I lose? I went $200,000 above the asking price. Why? Oh, they accepted one that went 300,000 over. Holy crap. I didn't have a chance anyway. For one, makes the buyer feel less, clearly it's emotional, but it makes it less about them submitting a crappy offer. They did the best they could or whatever. And it's just like, okay, well, I didn't have a chance on it anyway, versus they lost by $50 or $100 or $1,000, whatever. In those scenarios, it's like, crap, like I was almost there. Okay, the next offer just needs to be this or whatever. So if you're working with an agent, tell them to do that when they accept an offer. It's helpful.
Because without that feedback loop, how do you learn? I mean, and it's not as important for you as a selling agent, buyer's agent to learn. It's important for your buyer to learn. Hey, we have a hypothesis that we can buy this house for this price with these terms. And when you find out that's not true, you'd like to know, well, what was it? Was it the type of financing? Was it my down payment? Was I didn't remove contingencies? Is it that we couldn't close fast enough? So it is nice when a listing agent can give you that not positive feedback, but feedback to close the loop for your buyers.
No, for sure. And honestly, like agents will respond to it and say, I really like, you'd be surprised how many appreciate that. I mean, you're not surprised how they appreciate it, but it actually is, where people are defensive in the sense that their offer didn't get accepted. They're kind of whatever. It's like almost like a calming point. That's like, okay, wow, I really appreciate you giving me that information because it helps. So nevertheless, let's move along. So here's a question or a comment rather that I want to comment. I want to comment on it as well. But the Bay Area tech worker are returning to the office. A lot of workers move to the Valley. Is it safe to say they will move back, causing an increase in the Valley and more demand in the Bay Area? Here's what I'll say. I looked up something today. My next Monday's video is going to be about California real estate. Again, I'm talking about what's happening. And I saw they showed the 10 most competitive cities in California, and 9 of the 10 are in the Bay Area. And I'm not just saying Bay Area, but like Northern California surrounding the Bay Area. So whether or not they move back into the Bay Area directly or not, that is the most competitive housing market in all of California. So 9 of the 10 cities were up there. The 10th, not the 10th in the sense that it was number 10 on the list, but was San Marcos, which is down in San Diego area. So, but all of those outside of that were right around the Bay Area. So whether you're in it, moving back to it, or just outside of it, I don't think it really matters. It's a super competitive housing market up there, and I don't see that changing for reasons that we've talked about here many times. Just a lack of supply and demand.
How were
Yep.
they measuring it, Jeb? Days until under contract? Days from
You know,
on market to under contract?
I noted the article. I didn't get into detail about how quick, but my guess is how quickly things are moving, like how fast homes are going into escrow, because that was part of the article as well.
Because I mean, you can't argue with it that it's even worse in the Bay Area. But I'm sitting here saying I deal with people throughout the state, and I don't really sense much of a difference. So if homes sell in 2.5 days in the Bay Area and it's 3.5 days in Southern California, it's literally 65 or 35% worse up there. But as a buyer, you wouldn't feel any difference. It's awful either way.
Now, we've been on for 1 hour, almost exactly to the minute here. Want to ask a favor: if you're finding any value at all, hit the thumbs up. Watch us weekly, share it, subscribe, do all that good stuff. It does help people see it, and that is the goal: helping educate home buyers, guiding you through that process. Tonight, we were supposed to have a little plus, if you will, but it was too late running into the show, didn't get it all set up. But essentially next week we're going to be giving away some merch, if you will, with regards to the podcast, some t-shirts and that sort of thing. So we're going to have a link for you guys to click on next week. So if you're here, be on the lookout. So good stuff there. Josh, what do we got here? So
I actually like this one. If you're ready to,
I don't know if it's the same one, but I wanted to click on this one before you do it because it was on the top of my head here. Have you ever negotiated a credit for an as is? Was that it?
No, because we need to just lead the show every week, because this might be the most common question that you get asked.
And the answer is yes, absolutely. Yes, ask even if you buy a house as is, there's a really good chance the seller is willing to do some stuff, whether it's a small credit or just fix some minor things. It's a lot less expensive. It's a lot less of a headache time-wise, just going back on the market, going into escrow, not willing to work with people, especially over minor stuff. So I would say, if sellers are reasonable, they're fair people, right? Fair and reasonable, very two important pieces here. A lot of times you can negotiate small things like this in a contract. Now, if you come in and say, hey, I want the house painted or, the entire roof fixed, you're probably going to get told to pound sand. But small things, yeah, absolutely. I have and will continue to always ask. And you should ask, even if you are in an as is, because the worst thing they can say is no. That doesn't violate your contract. It doesn't kick you out of contract. Asking doesn't do anything other than bring up the topic in which they can answer it, and you can move along in whichever direction you want. So 100% ask. Ooh.
If you don't ask, the answer is always no, Jeb.
Absolutely. Elon Musk is here. Just want to say thank you for joining us, Elon.
Big fan of the show.
Yeah, big fan. I appreciate you being here. What was the question you had there, Josh?
It's the next one right below it. So ethics question: working with the realtor trying to get an off-market showing, learned another realtor was able to show the home previously. If our realtor is unable to broker a showing, can we reach out for a chance to see the property with the second realtor? So this kind of comes back, Jeb, to that concept of procuring cause. It sounds like ATX flips. I think they flip in Austin, and it sounds like they are the ones that became aware of the property. So you go into the actual realtor side of it as an investor. I look at it and say, if I became aware of the property and I said, Jeb, or try to get me in to see it, and you were unable to, but Susie down the street has got in, I'm going to go to Susie. I'm the one that found the property. But what are your thoughts on that?
Yeah, I think that's fair. I mean, here's the thing is, like, an off-market property, being able to get in and see it, sometimes there's reasons. Let's just, come out front and say, sometimes there's reasons that they're not showing it again. Maybe it's the seller that decided, hey, we're not doing any additional showings, whatever the reason is that you might not be able to get in there. So your agent might be doing their job trying to get you in there, and for whatever reason they can't, or maybe they're going into contract. So it may be worth a call to the other agent to see if they can make any headway, and if they can get you in, then maybe that's the direction you go. But if they end up with the same conclusion or the same answer and can't get you in, then you know that it's not your agent that's not doing their job. You'd be surprised, how many times, somebody says, I want to see a property. I call, can't get anybody on the phone, can't get anybody to return a text. Buyer calls, all of a sudden there's a response, whatever. And it's like, okay, it's, a lot of times, not saying this is all, a lot of times that agent wants to try to find the buyer themselves and do transactions that way. But in this case, they've already let a realtor see it. So it's hard to say, without knowing the details of the situation. Josh, what were you going to add to that? Anything?
No,
You
I
gave yours
pretty
up
much
front.
led in with it. No, what I was actually looking at over here is sort of back to investors flipping, blah, blah, blah. Ron lives and invests in Indiana, 70 plus units. Cash flow is great. Indiana happens to be one of the states Jeb and I are talking about. Jeb, you have a good contact is in Fort Wayne?
Yeah.
In the Fort Wayne market. My mom bought a duplex about 14 months ago in Speedway, Indiana. And I look at it, I'm like, that cash flow is ridiculous. I mean, is
Yeah.
it some jewel of a property? Are you like tickled to say, hey, that's my place? Nope. And it's probably not going to double in the next 10 years like something could in other parts of the country, but the cash flow is something to envy.
No, like I don't even know if you know this because you were gone. Like it was when you were in Florida, but I put an offer in. Nikki and I put an offer in on a property in Fort Wayne. Agent called me, gave me a tour of it. It was something I was looking at anyway, based on the emails I sent. I asked his suggestion on where we should be price wise. Continue, we basically took his 100% what he said, and we made the offer. The property was listed at 195 or something. We made an offer for 215. Waived appraisal, did the whole thing, and he basically said, he came back and told me, he's like, I wouldn't pay more than 215 for it. He's like, it's probably going to, he came back after the fact that said, it's probably going to sell for a little bit more. Ended up selling for 225. So we didn't get it. But I took his advice and it just didn't happen for whatever reason. But that property, was going to bring in about 1695 or so with regards to rent. It was
That's a
going to
lot of
cost.
money for a $225,000 house.
Yeah, and the mortgage and everything included on that property was about $1,100, 12, maybe 1,200 with the property management fee. I don't remember the number exactly but it was like it ended up being, actually it was a little bit more than that. It ended up being about a $350 per month positive cash flow once everything was said and done. And so to me, it made sense. And would I probably have done it at 225? Maybe. I mean, I might have, looking back on it at this point, just because nothing else has come up there. But you got to just figure out what's important.
What would that have done? 10 grand extra. Either you pay part with 10,000 of your dollars, or
cost me $50,
50
right?
bucks.
Or something.
$50 of cash flow, you're losing out by paying $10,000 more. So you were what would have been 450, 500 cash flow, takes it down to 350, 400, 450. It's still really good cash flow. So what I'm sitting here thinking when I hear this, Jeb, is our folks here in California that don't think that they can invest. What we should do is get like 20 of them with 50 grand. We put $1 million fund together, and then we're the hedge fund investors just rolling up Fort Wayne, Indiana.
There you go. Well, if you need the contact, reach out to me. I'm happy to put you in touch and maybe compete against you as a potential buyer. It'd be great. We can all just compete against each other. It'd be fantastic. Let's see what we've got here. If you see a question, Josh. Oh, here's another good one. Stephen Yates. Wanted to thank you, Jeb and Josh. I closed my house today. Appreciate all the help and guidance. So congratulations, Stephen. Awesome stuff, man. That's fantastic. Glad to see that happened.
I would actually like to say thank you, Stephen, for letting us be a part of that. I think we started talking right around Christmas time. It's a tough market. You did the hard work. You know how to, you knew what your radius was in terms of where you were comfortable living, what you and your fiance needed, and found a nice property that works. So super glad that we were able to be a part of it and appreciate it.
Where was Stephen again? I don't remember.
Why am I dumb? It's somewhere northern
NorCal.
It's an open-ended question.
Yeah,
I'm opening up a can of worms.
One.
We only have 59 minutes left or 49 minutes left to go into detail. No, it's somewhere in NorCal. Why am I drawing a blank on it?
I don't remember either. I have it somewhere, but anyhow, congrats to you. That's awesome. Good stuff. Let's see. Got some other questions here.
Actually, a good one here. This is one that we haven't had come up. And just before we even ask the question, I would like to put this one out there. We have a buyer that just went under contract, came from another group that we moderate in for veterans. She got an offer accepted in Compton, and we're going through it. And she goes, I really want to understand all this. I've never gone through it, so I'm sorry for asking so many questions. And never apologize for asking questions. There are no dumb questions. It's a big investment, probably the biggest one you're going to make in your life, the biggest debt you're going to take on in your life. Never apologize for asking questions. Ask them until you understand. So JT Owensby says, does debt to income include taxes and insurance when calculating what we can afford? 100%. The lender has to calculate everything that goes into your payment. So principal, interest, taxes, insurance, flood insurance, if there's any, homeowners association, special assessments, anything that you're going to be required to pay every month, you will need to include in the debt to income ratio. Now, it's a little bit more complicated when we talk about your liabilities, because certain things like your auto insurance does not get factored into your debt to income ratio. It's really anything that shows up on your credit report or liabilities like child support, spousal support, that fun stuff. But in terms of debt to income and qualifying, 100% everything that is included in your monthly payment gets included in the debt to income ratio.
Good stuff. We do have a super chat from 2M. I'm going to click on it in just a minute here, but there's two questions that are pretty easy to answer, and I just want to click on them while I'm here because otherwise it gets convoluted in getting back to the spot that you were at, guys. So Mike says, for newer agents, would you recommend joining a team or trying to do it solo? Team, I think, is the best way to go to learn the business. Unfortunately, real estate education, getting your license doesn't teach you how to do real estate, to sell real estate. I think it's important to be on a team or an in-team environment just because you have more touches, if you will, with regards to transactions, right? There's more activity around you. You can learn it faster. And once you learn it, have a grasp of it, go out on your own. Doing it solo is definitely an option. It's just, there's a lot of little nuances to the business that you can learn being surrounded by other people, learning from them in that team environment. I didn't go the team route, but looking and seeing what teams are today versus teams weren't really a thing when I started in the business. They are very much the thing at the moment. It's almost like a trendy type thing to say you're in a group or a team or what have you, but I think you can learn a lot from that. Second question, Henry says, can you really sell a house 100% as is? 100% you can. That's the easy answer to that. Yes, 1000% you can. Now, 2M, is it odd for me to offer an agent 3% on a $160,000 condo? So I'm assuming you meant you're selling the condo and you're saying you'll pay 3% to sell it. Is it odd? I don't know that it's odd. Will an agent do it? Sure. I'm sure somebody out there will do it. I can't really talk commissions and that sort of thing just because it's a very, very fine line with regards to real estate and all of that stuff. I personally wouldn't do it. That's all I'm saying. Like, I wouldn't do that. And there's a lot of reasons that go into it, but my time is more valuable than that because that 3% gets split and whatever else, depending on how they put it out there. But that's a whole different conversation. I'm happy to have it off air, and talk you through it but I think it's important, for many reasons in going a different direction. But Josh, anything you want to add on that? You can talk commissions.
No, it's really, it comes down to what's reasonable in the area, and what someone, what's the flip side is what we get all the time. Hey, do I have to pay 5% on if I'm selling a $2 million house? You're like, well, probably not. But the most important thing is that you get someone that is going to give you a return on that would be the biggest thing I would say. And then Jeb, jumping back, you jumped off the question from the guy, should he join a team? We get a lot of loan officers in here that are watching and following along with this as well. If you want to get into the mortgage business, I can tell you that loans from call centers are horrific for borrowers for the most part. But if I was to try and get in the business today, I would go there for 6 months. That you'll see, again, the same exact reason. You'll see more deals in those 6 months than you're probably going to see in your first 2 years out on your own trying to generate your own business. And no matter how smart you are, there's only so much book learning you can do. You have to see deals and analyze them and run through them. Now, the downside to most call centers for a loan officer is they split it up. They don't really let you analyze them as much as you should, but a smart, motivated person can see files and work their way through enough of them to learn in a really short period of time.
There you go. This is here, so I'm going to answer. It says, hope you guys are Will I admit I'm wrong about prospective rates? Your predictions about rates are far off according to this time of year. Yeah, my prediction was off. I didn't think you would see rates as high as 4%, especially this time of year. I thought, high side would be 3.75. We're now pushing over 4%. Yeah, I mean, I give a lot of predictions, guys, based on, not a lot of information, unfortunately. It's just what I'm seeing in the market. So rates have gone higher than I thought they would. At the same time, house prices have gone higher than I thought they would, right? I didn't think you would see double-digit appreciation this year. I said that. I didn't think you could duplicate what we saw in 2021. I was wrong. We've seen a stronger housing market than I thought was possible already this year. So I make a lot of predictions, guys. Take them with a grain of salt. What I will tell you is always do what's best for you. Don't lean into a YouTuber, quite frankly, to make your decisions. Just use it as a piece of information along with other information you're gaining, right? It's don't just read one source. Don't just take one person's advice. Get information from all and make your own decision on it. Because again, we can be wrong at different times for different reasons.
Along those lines, Jeb,
Yep.
some of the best advice I could give you. There's an amazing book, Annie Duke, the poker player. She also, I think, has like a PhD in psychology and game theory and all this fun stuff. But she wrote a book called Thinking in Bets, and it's not great just for situations like this. It's great for everyday life. So when you say something incredibly confidently, like 25-year-old Josh would tell you that he knew everything. So if you asked any question, it was 100%.
48-year-old Josh would tell me
100%. Well, I'm 99% accurate. But what her thought process is, she asks a basic question, and then you answer that, and you go, okay, well, what's the odds? What is your confidence? Are you 90% confident? Are you 60% confident? Rarely are any of us 100% confident, and neither Jeb nor I would tell you with 100% certainty this is where rates are going to be next year. If you look back, I still think those were very reasonable expectations, and we're going to see. We talked earlier in the show about things that were unforeseen and are changing in world economics that could lead to elevated interest rates going forward. But the bigger impact that we've seen and known for 30 to 40 years in over indebted economies like the US is it's deflationary and it leads to lower interest rates. So if we're going to sit here and say we're taking bets on where interest rates are 5 years from today, I'd say with 60, 65% certainty, they're going to be lower than where they are today. Now, what happens and how we get there, that's the fun part of seeing the news every day and analyzing it. We talk here every week. Part of why I'm good at what I do and making good projections going forward is reading a lot of really smart people and reading them over a long period of time so that you start to know their biases. We all have biases. I was in a training one time, and basically it was on programming for CrossFit classes. And the guy said, we're all biased. If Jeb is great at running and he's programming the workouts, there's gonna be a lot of running in there. And if I'm great at deadlifts, there's gonna be a lot of deadlifts in there. That's true in every aspect of life. So if you're relying on other people, that's fine. That's how we get information. But start to know their biases and their potential blind spots, who you weigh most heavily. The biggest issue you can have, I always say this, the people that come to me that are the most screwed on their current loan or late in a transaction and wondering why everything's going sideways are the person that went to one person, took what they said as gospel and never did any research, never backed it up, never checked anything. So do your own research, come to your own opinion. And if anyone tells you with 100% certainty they know what's going to happen tomorrow in real estate and interest rates or any other area of the world, just ask them. If I've got a gun to your head, are you going to tell me you're 100% confident that thing's not going to go off if I pull the trigger?
There you go. Jennifer Lego. Best comment tonight. Silence 2 viewers this evening. Fantastic, Jennifer. Thank you.
Well, the worst part, one of them that she ended up having to silence, it's just, you can tell they're watching news. I won't say which brand of news, and basically just parroting the most
Oh, I
like
didn't even see it.
fear mongering stuff ever in the history of the world, like the most sensationalist headline, and just going down a rabbit hole. Like, dude, first of all, or girl, whoever you are, you don't know what you're talking about. You are just
They're not
parroting
here,
what you
bro. They're
heard.
silenced. They got
No,
silenced.
but that's what I'm saying. It's just be careful. We all have to gather our information from somewhere. We read, we watch, we go on YouTube, but pick good sources, work through them, and come to your own conclusions.
There you go. Let's go. Let's
I got a
hear.
good question and a good username.
All right, let's hear it.
Rianu Keeves. So
Oh,
don't get
yes.
twisted. It's Rianu Keeves, and I like his little teddy bear over there too. Does the amount I qualify for a mortgage depend on my last two W-2s gross average or my current monthly gross pay? So as long as it's not variable income, we're going to go with your current pay. So if the last 2 years you made $20 an hour and on January 1 you got a raise to $40 an hour and you work 40 hours a week, we're going to use $40 an hour. Now, if we have you make $25 an hour, period, and you also work 20 hours a week of overtime, we have to average in the last couple of years overtime. So really it comes down, is it fixed income or is it variable income? Salary or 40-hour a week, we're going to use the current, but if you have commissions, bonuses, overtime, that type of stuff is going to have to get averaged.
Good stuff. Instead of telling me I'm wrong, Saeed said thank you. So I'm going to post that out there. Says open escrow yesterday. Thanks for your help. Congratulations. Awesome. In this market, that is a feat in and of itself. So congratulations to you. That's fantastic. Let's see. What else do we have here? So here, I saw someone a moment ago. Oh, they gave me a super chat too, and I didn't even answer the question. I apologize, Peter. Thank you for the super chat. Peter says, put down, done 15 offers over the last 2 months in Prosper, Texas, putting 20% down, waiving all contingencies, 5 to 7% over the asking price. What else can I do? Sounds like you're doing all the right things. It's tough, right? Be patient. That is probably the best thing you can do in this environment is just, sit tight. You might try to go get a full underwriting approval, go ahead and get it done and ask the lender how quickly can they close. Try to get everything in there. So all they need is really a property. A property address, be able to order the appraisal. You might even get in a waiver based on, your scenario there, but nevertheless, they need an appraisal and some title reports and that sort of thing. So you might be able to do a short-term escrow. Maybe instead of doing a 30-day or 21-day, you might be able to do a 7 or 10-day. Maybe that helps. Maybe you offer the seller free rent back. Maybe even if they don't need it, just say, hey, listen, we'll close in 7 days. We'll give you 30 days to rent back for free. Whatever. Just you got to think outside of the box on some of these things. And outside of the box isn't always something that you want to do just because it's like, okay, well, that 30 days is going to cost me money and they're living in there rent free. Yeah, but it keeps you from having to continue looking at property and paying more for the next one. So maybe you do some of those things. Outside of that, it's hard to say because, based on what you wrote there, it looks like you've got, everything done. If your lender is not talking to the listing agent, that would be something I would add into the scenario there, just to keep pressing along. Send letters to the neighborhoods that you are making the offers in, and go door knock them yourself. Say, hey, listen, I lost out on the property down the street. I'm a buyer. I want to buy your house. I don't know. That sort of thing. That's the stuff that is crazy, but it's the stuff that actually ends up happening, believe it or not, in some of these scenarios. So
put it on Facebook. Everything that you might be able to do in your social. Hey, I'm interested in buying a home. I'm pre-approved for this
you
amount.
did
We
the
want
full
to be
approval already. Yeah.
in this school district, any and all of those things. And make sure both of your professionals, make sure your Jeb and your Josh are doing everything possible on those. And from the loan side, the biggest thing is following up with a call on every offer. If the listing agent doesn't answer, leave them a video, point out all the highlights on the file, answer any questions. If it is fully underwriting approved and you can close in 10 days, point all of those things out. And from the realtor side, like I don't, doing a volume of transactions doesn't guarantee you're working with someone that's great, but the more transactions they do, they have more relationships. Hopefully they're working out of a big office versus someone working out of their home by themselves. Just again, it goes back to the whole social network, whether it's Facebook, Instagram, whatever. Let everybody know. My cousin got a house last year in North Idaho, one of the craziest markets in the country. They're all crazy, but it's one of the craziest ones. And they missed out on 6, 7, 8, 9 houses. And finally, they were at their favorite bar and grill where they hang out, and they were talking. And the guy next to him says, "Hey, I want to sell my house." They ended up buying his house at a number he was happy selling at, a number they were happy buying at, and everyone walked away happy, and they got beers afterwards.
Yeah, and here's the other thing too is that, escalation clauses. I saw somebody comment there. I didn't mention it, but if you're not using escalation clauses, use it. Don't put a cap on it. Just see where the damn thing goes. And you don't have to buy the house just because the house reaches that price. You could say, once you figure out the price, I'm out. I'm not doing that or whatever. That's one option. Second option is, if they're not allowing love letters, the agent to submit love letters, go write one yourself and go put it on the doorstep. I had someone do that to a listing I was selling last year, last year, or maybe the year before. I don't even remember at this point. And they just dropped it off on the doorstep directly, bypassed the realtors altogether, and the seller got it. I mean, that was, and they were moved by it. They didn't end up going with that offer just because of some other reasons, but that's the stuff you got to do to stand out. Try to, I'm not telling you to go knock on the door, but
And Jeb, this is the question of the day, because there's just another version of it. Carolyn Tomlinson came in second place on her offer. The details don't matter, but waived inspection, 25,000 earnest money. What did we do wrong? What could we have done better? It's basically the same answer you just gave. It's the same stuff.
Yeah, it's all the same stuff. I mean, that's the thing, is that people are beating themselves up out there in this market because they're like, I did, everything I could have and still not making progress. Yeah, the thing is, you guys aren't in the same market, Caroline. I don't think, you and Peter, but if you were, you both are doing everything that you're supposed to do to get an offer accepted. And that's the thing, is like the seller is only able to pick one. And there are multiple of you writing very strong offers for that one property. So it's frustrating from your side, because you are doing everything that you're supposed to do, everything right, and just not making that progress. So unfortunately, there's not a lot I can give you, because you are doing the right things in order to present your offer and stand out. So, and if you're not doing any of those things, add the things that I mentioned on there, and maybe that helps you get your offer accepted. All right.
So we have some updates.
Okay.
We're an hour and a half into the show. Simple name, finished the weeding. Agrees with Josh. Those are two important updates. FHA loan is best, I believe, but I also qualify for conventional, have 60% equity in the home. What's the best option in that situation? Again, depending on where you're at, if you're in California, give me a call. If you're outside of California, Jeb has the form he can throw up here for the referral. We'll get you connected with an expert who can do that side-by-side comparison. When you see it on paper, it's going to make sense. One of them is going to jump out at you once you factor in the FHA mortgage insurance, the FHA upfront insurance, mortgage insurance premium, and you'll look and you go, cool, that one's better for me.
Good. Jameson has an interesting question here, something that often frustrates me as a real estate agent. Can I sell a property without any showings? I own a property that I have a family in, and it's becoming a nightmare situation. I can't reason with them or get them out. So what I mean by frustrating from my side is, oftentimes I'll get a buyer or client that says, hey, I like this property. It came up online. Can I see it? And then I go look in the agent remarks and it says no showings. All offers are sight unseen. And it's like, really hard to get a buyer to make an offer or, suggest that they make an offer on a property that none of us can see the inside of. So can you do it? The answer is yes, but there's a caveat, is that once they go into escrow, you're going more than likely have to be able to get them in to see the property, to do their due diligence on that property. Getting someone to buy a property that they're not able to see the inside at all, that's going to be, can you do it? I'm sure you can, but it's going to be at a discount, right? Most people aren't willing to take that risk without some sort of huge discount, taking on, buying a property like that. So I would say, if you want top value, top dollar for the property, you need to be able to get people in there. And really, and by what I mean by that is, you know, exposure drives demand, demand drives price. So you putting the property online gets the exposure. How you get the demand on the property is getting people in there to see it, all being able to see the interior, see what they like, whatever. And then that demand ultimately reflects in the price. So if you can't create that demand around a property because no one can see the interior of it, your price is going to reflect that. So again, best interest. Now, if you've got people that are uncooperative for whatever reason, then it might be in your best interest to vacate the premise, do a 60-day vacate. And once they're out, start showing it. But if they're not cooperating for many reasons, I mean, oftentimes in your lease agreement, I'm assuming it's a family that you're leasing a property to and not your family at home. But oftentimes in your lease agreement, there's something in there that says that you, as the owner, the property manager, can go in that property within a 24-hour notice. And so you start threatening and saying, hey, listen, here's the situation. Property's going on the market. I have to give you a 24-hour notice. I'm giving it to you now, and start showing the property. Is it ideal? No. Could it create other issues? Absolutely. But you've got to figure out what's important. So I don't know that there's an easy answer there. It sounds like a difficult situation. But me as a real estate agent, I've dealt with those many times. Find an agent that's comfortable having those conversations. It's one of those things that, as an agent, I've had people that are uncooperative, but I just try to sell myself on, hey, listen, here's the deal. Sellers wants to sell the property. They're going to sell the property. I'm just the middleman. I'm trying to make it easier on you as the tenant, right? So if we work together, it's going to be a lot easier situation than me just giving you a notice and showing up and whatever. And I use the idea of helping them try to find something else. If you are the landlord, if this is a rental, maybe you give them some money. Hey, listen, here's the deal. I know this isn't ideal, but for your headache of showing the property and doing this sort of thing, or allowing us to show the property, I'll give you free rent for the next 60 days while we sell it, or I'll give you 10,000 or whatever. Yeah, it's not what you want to do, but it beats the hell out of going to court and having to deal with, actually kicking people out of property and that sort of thing. So, again, I don't know if there was a perfect answer to that question, but those are the things that I would consider if I were in your situation. All right.
Where are we? I got a good one for you, Jeb.
Let's hear it.
Michael August says, my home is worth $300,000. Is it okay to ask $400,000?
I would suggest that you ask $300,000 for it, with the idea that here's something I mentioned in a video. I don't know if I mentioned this in a video that's coming or in the past, or if I just had a conversation. I know you and I have talked about it, Josh, but you cannot underprice a home in this market. You can't. And what I mean by that, if a home is priced, and I'm even saying that at fair market value in our market at the moment, if you put a home on at fair market value, what it's worth, it is going to sell for more money. In fact, the state of California, the stats that just came out on Redfin, the average home is selling at 104.9%. 104.9, I think, over 104%. So that means for $1 million home, on average, $40,000 more that home is selling for. That's a lot of money. And now 300,000, obviously that's not going to reflect, that's going to be 12 grand. So the chances of you getting 400 on a $300,000 home aren't high. But what I would tell you is that if you're pricing it, 25% over what it's worth, or 33% in this case, you're probably just going to sit on the market and not get anywhere. So pricing it closer to where it should be, well, ultimately the market will tell you what it's worth, versus you trying to tell the market, hey, this is the price I want, right? Let the demand, give you the price that the market's willing to bear.
Look at the psychology of it. If you price it 33% above what the market generally thinks the value is, they're going to think you're a dick and you're unreasonable, and probably not want to show the property or make offers. If you price it 50% under market at 200,000, you would think people would think you're not serious. There's a catch. There's a problem with the property, but everyone somehow thinks it's magic. Now, the problem with doing that is you will get every person that's qualified for exactly $200,000 to come make an offer on your property, knowing it's going to go well over 300 or reasonable buyers and agents knowing it's going to go over 300,000. But to Jeb's point, you can't underprice a property. You can overprice it, which doesn't mean that it won't sell. It'll just take longer and probably sell for less than if you had priced it appropriately.
Good stuff. There was a comment here I did want to click on, and now I lost it. Where is that comment? Here it is. Shane said, just sold my house. The buyer put in a good offer with an escalation clause for $1,000 over the best offer. They got the house. Put the escalation clause for $1,000 over the highest offer. Don't put a cap on it. Just see where it goes. See where it goes. And from there, you can decide whether or not you want to buy the house once you figure out the price, right? Let's see. We got a super chat from Mr. J. Lost out on an offer today. I'm assuming a guy in LA. Came in fourth after offering $920, $75,000 over the asking for my wife and I's first home. What point is that not, or is this not worth it? Unfortunately, that's got to be something you decide. Everybody has their tipping point, their line in the sand, and each person's is a little bit different for one reason or another. If your parents lived next door and, best friend lived on the street, your threshold might be a lot higher than the next buyer because of reasons that they can't relate to. So you just never know. I tell buyers all the time, you're going to know when it's the right house, right? But that doesn't mean that you're going to win it. It just means that that's the right house to make an offer on at that time. Now, again, it's an environment where things are moving so fast. It's difficult to know what others are willing to do. It's the most difficult part of my job is trying to figure out what someone else is willing to do. I don't know how many properties I've listed and or sold. Things have gone higher than I thought they would go. And I've been doing this a long time. And so now I'm even going, in my head above where I think it will go, and it's still exceeding that. So it's very difficult to figure that out. You just got to figure out what you and your wife, what you're comfortable with, right? Don't extend yourself past whatever that number is just to, get in. If you're not comfortable with it, you're going to have regrets if you do. And chances are, even if you buy the house and pay over asking, you're going to have some sort of buyer's remorse. It's normal. It's just, what are you comfortable with at that time? Josh, what is your take on that?
Hindsight is always 2020. But look, if we go back a year ago, we were having these same conversations. I think I'm just going to back out. Sure. This is crazy. This doesn't make sense. We're discouraged. We're not going to continue. We had Lupe on the show a year ago. 28 offers, I think you wrote for her.
No, we wrote
husband.
20. We wrote 20.
It was a ton of offers, and they were discouraged and unhappy. And
I was discouraged.
They stuck it out, and now they're sitting on 20% equity above and beyond. I think they put 10% down. So they would tell you it's absolutely worth it. Now, past performance is not a guarantee of future success.
Yeah,
is that what this?
Right.
So we can't sit here and say this year is the same, but we can say the people that stuck it out and bit the bullet and went a little bit above their comfort level last year are very happy about that decision. Is that always going to be the case? Probably not. But I think supply-demand dynamics, relative affordability. We know affordability is low compared to where it was 2 years ago, but relative meaning that we still have plenty of people who can afford at the current prices. As much as I would love to see prices level off for the next 2-3 years, I don't think they're going to. I was reading an article. We talk about one of the smart people that we read is Logan Mohattashami over at Housing Wire, and he had a projection 2 years ago of
where home prices. Has he turned us down on our interview request yet?
No, I bet you we'll get him. I haven't reached out yet, but he pointed out again, forecast not being correct. He started with the wave of millennial buyers was going to lead home values up, and we have already exceeded what his projection was for the end of 2024. So he thought we would get here. He thought it was going to be 2 years down the line, but that millennial wave is still there. So absent something really unforeseen happening and pushing rates up another % from where we're at right now, we still have a lot of able demand wanting to buy homes. So where is the risk level? We talk about thinking in bets. What would I bet that home prices are higher a year from now? I'd bet a pretty big chunk with a pretty high degree of confidence. I wouldn't say with 100% certainty. You only know in retrospect when you see inflection points, but we've listed in detail all of the things that have to happen. Like anytime you believe something for sure, you're 100% certain. The best thing you can do is step back and say, what would have to be true for me to not be correct?
And
And
here,
like the
and I want to add to that, Josh, you made that comment. Josh and I have this conversation every day, and I have it with a lot of smart people. A buddy of mine runs a fund out in Charlotte, a hedge fund, and they have access to a lot of smart people, a lot of money. These are people I'm calling and saying, dude, what am I missing? Like, what part of this equation are we missing in the fact that we're talking to home buyers, telling them the market's going to appreciate? But nevertheless, keep going, Josh. Sorry.
No, that's what I'm saying. I have not come up with, there's things that we throw on the board. I mean, the craziest one, you talk about Putin has nukes. You launch one of those and it's a whole different world, literally, for all of us. Other things can happen that are almost unfathomable. But inside the realm of what could potentially happen, I don't know what can happen in the next couple of years. When your average home with a loan is at 47% loan to value, you don't have a recipe for a big wave of distress of properties coming to the market where people have to sell at any cost, or it's very hard to find a recipe for lower home prices. So if you can afford, obviously would never tell anyone to, okay, well, you're qualified for 500, go to 550 and just get the house, when that takes you beyond your comfort zone and your ability to qualify. But if you could do it, if it takes you beyond your comfort zone, yeah, you have a house and you may be happy with that decision in the long run, but in the short run, you're going to deal with some stress and unhappiness. And if you're a man and you have a wife and you put that stress and unhappiness on her, it's going to triple your unhappiness. So I would suggest not doing it.
Yeah, good stuff. There was something here. Well, Simple Name first off came in with a $10 super sticker. So thank you for that.
Where's the sticker? What sticker did we get?
We got a dancer, like a bot. I think no muscles.
I like that.
Looks like my 7-year-old in the mirror just flexing. I'm serious. Let's see
just
here.
Repeatedly showing you his giant muscles.
Flexing. I saw a comment here that I thought was worth putting up here, and now I have lost it. I apologize, my friends, for losing it.
Next week, Jeb, I want you to share a picture of Nash flexing.
I will. I probably have one on my thing here. He would be so embarrassed. So a question or a comment rather. So I got approached by someone from USDA who wants to do a video. They've been at USDA for 30 plus years, and I'm going to interview them, not necessarily an interview, but talk to them about USDA loans. So one of the questions they had was, are there any specific questions you think your viewers have about USDA loans? So if you are interested in USDA, the greater majority of the United States can use a USDA loan. Here in Southern California, major metropolitan cities that aren't deemed rural cannot use USDA, but 99% of the U.S., from a land perspective, I think is pretty much accessible or has the access to use USDA. So if you want USDA, you're considering USDA, you have questions about, put it in the comments, because I will take those questions and I will direct them on video. And I'll put something out on my page too to ask that directly so we can have a list of questions. But I just wanted to throw that out there before I forgot. You mad now says, got new construction at asking first bidder and appraised 5% over. Closing is being pushed out 5 days past our rate lock. Do I have options? So Josh, so a $5 super chat. Thank you for that. What are your options if closing is being pushed out? Is that the builder's responsibility? Is that the lender's responsibility? Who needs to pay that lock?
So generally, how many times have we talked about this, Jeb? Your normal contract is 8 to 20 pages, depending on what state you're in. A builder contract is usually 120 pages. And in there, it spells out all the things the builder is not responsible for and things that they know are often going to happen, such as an extended closing. They're going to tell you they're not responsible for it. The good news is 5 days past as long as they hit that date, 5 days, a rate lock extension is going to cost you 1.5 to 2 basis points a day. So let's go to the high side, say it's 2 basis points a day. 5 days is going to cost you 10 basis points. So it's 1/10 of 1/10 of 1% of the loan amount. So if you're getting a $300,000 loan, it's $300 to extend that rate lock. You're not going to lose your lock, but you're going to have to pay to extend it. And I would almost guarantee you that that contract spells out that the builder is not responsible for delays in closing due to construction delays.
There you go. And if you end up paying it and you need your $5 back, just reach out and I will Venmo you your $5 back so that you can use it toward your rate lock. But hopefully your lender somebody steps up and just takes, it's a couple $100. It's not a huge amount. So hopefully, it's not a big deal, but it should be something that should be able to be resolved. All right.
Jeb, an interesting follow-up here to the my home's worth 300, I can sell it, can I ask 400? So Carolyn says houses that are priced way too high stay on the market longer. There's currently a house in her market where she's saying I can't get anything under contract. It's on the market for 18 days because they're asking 401, which again, in some markets 401 is a giant discount, in some it's a very, very expensive home. But 18 days, you're probably in what she's saying is a hot market. I think she said North Carolina. So in a hot North Carolina market, if you're in the market for 18 days, your price isn't right, and that's someone trying to dictate to the market the value versus letting the market set the price.
You always have the people out there that are like, hey, I'm a seller, but if they pay this, I'll sell my house in some stupid price. So don't be the stupid price person. Be the person, if you're trying to sell it, if you're just testing the market, sure, do whatever the hell you want. But if you're really a seller, it's only going to backfire on you in the long run. Because, days on market, because of other things, the way buyers look at days on market, how long properties have been listed, price reductions, all of that sort of thing. Better off just to go with the right price to start and just see what the market does. And then from there, you can decide on, hey, none of these prices actually got where I wanted. You don't have to sell, but don't be the person that listed at 300 and you're not willing to accept an offer until it hits 400. That's also an awful approach, because then you're not really a seller. You're just somebody that is, hopeful that somebody will bring you that offer. So, but a 300,000 selling it at 400,000, as we mentioned earlier, is I don't care what the market's doing. It's not realistic. All right.
We got a good one here that we can't give an answer to. John Alster Guillermo says combined household income 129,000 for 2021. First time buyer. Do we qualify for any down payment assistance in Minnesota? Jeb, if you want to throw that referral link up there, we have an amazing loan officer in Minnesota we can connect you with that specializes in first time buyers and first time buyers buying owner occupied units. But he knows all about the assistance programs in Minnesota and can get that answered for you. So fill out the form. We'll get you connected with him and get you an accurate answer.
All right. Let's see. So this is a good question. What happens if someone no longer qualifies due to higher interest rates? Do they get their deposit back? So we're going to assume that you are in contract, right? You've made an offer on a property. One of your contingencies is still in place, which is the loan contingency. Here in the state of California, the way the contract's written is you have 17 days to qualify, to get your loan approved in order to release that contingency. And, at that point, once that contingency is released, your deposit's at risk. It doesn't matter what happens to interest rates. If you don't qualify for whatever reason, you're done at that point. Now, some states like Arizona allow you to have a loan contingency until 3 days. I think it's 3 days, 3 days before the close of escrow, if I remember correctly. So those states allow you to have that contingency in place a lot longer, which means a rise in rates means you don't qualify, means that you don't have to move forward. So each state's going to be a little bit different. So depending on where you are, something that you need to make sure that you do qualify when you go under contract, you need to make sure you get your loan locked, right? If you're in contract and you're sitting here trying to play in your borderline qualifying or not based on where rates are, don't be stupid. Wow, that was aggressive. Don't be dumb and play the shopping the rate game lock the damn rate. That way you don't have to worry about it going up or down, because if it means you don't qualify, you're going to put yourself in a tough position really early on. So just lock the rate once you go in. Now, if you're going to qualify and you've got, you're a gambler, you're willing to take on some risk, okay, sure. But in the case that your ratios are tight, not the game to be playing.
1,000%. And Jeb, we bring up the candle charts every few weeks here, and it probably makes everyone's eyes glaze over. But it is stunning how few loan officers have any idea how the market works and how technical analysis works, or pay the money to subscribe to a service of someone that will tell them every morning how it works and what they should be doing. My wife is a wholesale account executive. Her clients are mortgage brokers just like me, and I'm shocked and amazed at how many of them will submit a loan on a purchase or refinance. Rates are worse a month later, and like, oh, we got to cancel that. The rate's not there anymore. You're like, you just lost a deal for yourself, putting food on your table for your family, and lost your client's ability to get a loan that they qualified for a month ago because you wanted to get cute with the rate lock. So two pieces where I like to go with that. Understanding the technicals gives you the ability to count cards in blackjack. Doesn't guarantee you're going to win the next hand, but it lets you know when the deck is stacked in your favor and when it's against you. And since December 28th or so, the odds are definitely against us. No one should be getting a home under contract and not locking immediately. There's been a couple of days where, for clients who are not risk averse, that was the second piece I wanted to say. I always ask my clients, when you get to Vegas, are you stoked to go to the spa and go over to Caesars and go shopping, or are you just dying to get to the blackjack table? Because if you're not a gambler, you're probably not the person that wants to float a lock while they're in escrow, regardless of what counting the cards at the blackjack table tells us the odds are in our favor. I mixed my metaphors. I just had a non-gambler gambling and counting cards. I probably shouldn't have done that.
It's okay. We'll let it slide this time. So I was gonna say something a moment ago when I had a comment on the screen. I actually like the way that looks better because it's not over, it's kind of off the screen. So as long as you have a comment there, I feel like this format works better just because, doesn't cover up my fantastic beard when I'm showing them, like this, right? It's underneath the photos, but nevertheless. Anyhow, I just thought I'd put that out there.
Jeb,
Um,
I want to get to this question because this person asked it at 6:24 and then politely 20 minutes later asked if possible if we could get to his question back at 6:24.
Let's see.
We don't have an answer is what the answer is. Selling a home in Northern California, going to get net proceeds of $200K. Do you think I can buy cash and land a decent single family home in a decent neighborhood in South Florida or
No.
Southwest Florida?
No, I don't think you can. 200 grand doesn't do what it used to. So that's the thing, is that when I think South Florida, you said Southwest Florida, but when I think South Florida, I'm thinking, Fort Lauderdale, West Palm Beach. I'm thinking those markets, and absolutely you can't for 200 grand. Now, Southwest Florida, I'm not sure what's on the Southwest side, what's on the other side of Miami-Dade County and all of that area on, I don't know right off the top of my head, but 200 grand, unfortunately, doesn't do much, especially in Florida at the moment, just because there's so many people moving out of, areas where it gets colder, Canada, New York, some of these, and moving to Florida. I don't know Florida well enough, but I mean, it's like saying, can you buy a $200,000 single family in California these days? Maybe, but it's probably not going to be anything you want to live in. So it's a tough one to answer. If you need somebody in that market, I can definitely connect you, just depending on what cities you're looking in. We'll decide on who that is. But off the top of my head, I'd say it might be a tough one to navigate at that price. You might need to double that and have a shot.
We also have a good comment here from Jennifer. She says she's a buffet girl. So she didn't go to the spa or shopping. She heads to the buffet instead of the blackjack table. And it's a good way of looking at it. Some of us just hate going to Las Vegas, but when you're stuck there for a convention or whatever.
Dude, you're going in like 2 weeks or something.
Yeah, that's my crazy cousin that bought the house from the friend at the bar. She's turning 50. So we get to go and spend a weekend in the wonderful capital of many things that we can't say here in public, Las Vegas, Nevada.
There we go. Let's do one or a couple more questions here. Jasmine has a good question here, and one that's difficult to answer. Do you feel like it's risky signing for a new build now when it's not projected to finish for 18 months? So
it's like an option. It's like an option, Jeb. It's like an option on the market.
It really is. Here's the thing: is even with them. I mean, you guaranteed you have to buy it. And I don't know at what point your deposit's at risk on that new build. So that's something to find out. I mean, most of the time, I don't think your deposit's at risk until you're actually like closer to. I don't know. Josh, it's been so long since.
We got to dig through that 120-page contract.
Yeah,
But
figure out when your deposit's at risk. I mean, it's definitely not 18 months from now, right? There's going to be closer to that time frame. And let's be honest, if it's 18 months, it's probably closer to 20 or 22 months if they're already projecting that far out. So just, maybe it's a way to hedge the market and put it out there. And if it's not there, you don't move forward. Hard to say on that one. Andrew says, taking my real estate sales license in 2 weeks. Any tips for new agents starting in this current market? Again, I'm not sure. Andrew's not the one to ask earlier about the teams, but I would say try to get on a team. Try to find somebody that's does some business. Be around them. Try to find some mentors. There's some good training out there online. Feel free to reach out to me. I'll direct you some sites that some things that I would look at if I were in your shoes at the moment. And last one here, we're going to read on this one. This is M. I think started the show by talking about something. If it was the same M, maybe there's multiple M's. Wanted to say thanks, Jeb, and never planned to get a home, and things changed January 1st and said done renting. You helped me go literally being clueless about what it takes to closing yesterday. So congrats to you. That's awesome. That's why I do this. That's, satisfaction. It feels good for people to be able to take it again from that point of not knowing anything to becoming educated and making the leap. So Josh, what do you want to add here at the end as people hit the thumbs up and,
it's a challenging market for everyone. Challenging market for realtors. It's a challenging market for everyone but sellers right now. So just keep your head up. Keep your eye on your long-term goals. Have a longer-term time horizon. Don't do things. We had about 8 comments tonight. Don't do anything out of just fear of missing out. Do what's right for you over the long haul. And if you've decided that owning and buying a home is the right move, stick with it. It's going to be trying, but often, in the long run, it's going to be worth it. It will build wealth. It will give you a home base for your family. So despite all of the negativity, hopefully we can give some peace and positivity here every week and give you some accurate insights into make the best decisions for you and your family.
No, good stuff. And there was a couple things you mentioned there. So earlier in the show, mentioned the podcast. It looks like that little logo up there in the top. Search it on platforms that you listen to podcasts on. Again, it's longer form content. So, 20 to 30 minutes, not nearly this long, but it's a deep dive into specific subjects about home buying, right? Why homeownership is important. Should you buy in 2022? The latest one we just posted this week, I think episode 6 was closing cost, talking about prepaids versus closing cost. And why that's important, in addition to your down payment, understanding that. And next week, we're going to talk about points, paying origination points, discount points, what's important there. So that'll post on Tuesday. So if you like podcasts, subscribe to that and follow it or whatever you do on podcast.
It'll make you work out, Jeb.
Just put it exactly on and it makes you work out. The person earlier said they lost 300 pounds listening to our podcast in 30 minutes. It was fantastic. I couldn't believe it. And they bought a house. It was just great. None of that happened. But it sounded good. Anyhow, I want to say thank you guys for being here tonight. We will be back next Wednesday. Appreciate it. All of you. Thanks for hitting 50,000. I appreciate the love,